Now let's look at 27A. All right, so 27A, we're looking at journalizing some liability transactions. So let's just jump in and start with the first one. So January 9th, it said that we purchased computer equipment at a cost of $9,000, signing a 6-month, 6% note payable. So we're getting computer equipment, so we debit computer equipment and credit short-term note payable. All right, then on January 29th, it says we recorded the week's sales of $64,000, 3/4 on credit and 1/4 for cash. Sales are subject to 6% sales tax. They want us to ignore cost of goods sold. So remember, we're going to debit the cash for the portion we received cash, debit accounts receivable for what's on account. So we're going to calculate that. Then we're going to record sales revenue. And then the sales tax that we collect is a liability. It doesn't belong to us. We're collecting it on behalf of the state. So for the cash, it says that the sales were $64,000. So we're going to take $64,000 times, well, first off, let's come over here. I'm going to come down here. So my sales were $64,000. All right, but I collected also 6% sales tax. So I'm going to multiply this by 1 times 1.06 to get what I collected overall. So this would be my sales plus my sales tax. So that's going to be total is 64,000 times 1.06. So I collected $67,840. Okay, in everything. So sales revenue and sales tax payable. So my sales revenue was $64,000 and my sales tax is $38.40. So out of that total there, a portion of it I got in cash. So I'm going to take $67,840 times what I received in cash. So 3/4 was cash, right? No, 3/4 was credit. So 1/4 in cash. So I'm getting a total of $16,960. And then the rest of it, $67,840 times 3/4 was on credit. So receivable, which is $50,880. Okay. So I'm going to take that. All right, so that's my journal entry for that one, and that's how I calculated it. Then I'm going to get February 5th. So February 5th, it says that we sent the last week's sales tax to the state. So remember, I collected sales tax up here, and it was a payable. So now I'm going to get rid of that payable. Oops. Of $38.40, and I'm going to pay it and send it to the state. All right. Then I've got July 9th. So in July 9th, it says we paid the 6-month 6% note plus interest at maturity. So I know I'm going to get that short-term note payable off my books for the $9,000. Okay, and I know I'm going to credit cash, but I'm also going to pay the interest on this. All right, so I'm going to have some interest expense that I'm paying. So let's calculate the interest. That short-term note was for $9,000. 9,000 times the rate, which is 6%, is going to be our interest, but that's an annual rate. Remember, the interest is at an annual rate. So I have to multiply it by how long I've had the loan for this year. So I got the note in January, so I've had it January, February, March, April, May, June, and we paid it on July 9th. So January, February, March, April, May, June. So I've had it for 6 months. So I'm going to do times it 6/12. All right. And when I calculate that, I get $270. So I'm going to pay a total of $9,270 when I pay this off. Okay. So that was July 9th. Now I'm going to get to August 31st. August 31st, we purchased merchandise inventory for $12,000, signing a 6-month 9% note payable. All right. So on August 31st, when I record this, I've got merchandise inventory. That's what I'm buying. Right. And I'm going to credit short-term notes payable. Okay. Then I get to year end, so I've got to accrue warranty expense. It says, which is estimated at 2% of sales of $603,000. So remember, I'm going to debit warranty expense. I'm going to take 2% times my sales of $603,000, and I'm going to credit my estimated warranty payable. So I'm going to take 2% times the 603, and that means I'm going to accrue $12,060. All right, so that's accruing my warranty estimate. Then it says they want us to accrue interest on all outstanding notes. Well, here was my first note, and we paid that off here. My next note I got in August 31st. So August 31st over here, it was a $12,000 note at 6 months, 9%. So it's 9% interest. So I'm going to accrue interest, and when I accrue interest, I'm going to debit the expense and credit the payable. Okay. And how I'm going to calculate that is I'm going to take the $12,000 of the note times 9% times the time I've had it outstanding, which is 4 months. So August, September, October, November, and December, because I didn't get it till the end of August. So when I do that, I get $360. So that's my accrued interest. All right. Then the next year comes around, and now we're going to pay off that note up there. Okay. So we know we're going to get that short-term note payable off of our books, and it was for $12,000. And we know we're going to pay some amount of cash, but how much we don't know. All right. And remember, we've had this note since August. We've already accrued some interest that we have to pay. We're not paying that interest until we pay the note on February 28th. So we've got to pay this interest payable here. So we're going to have to get that interest payable off of our books, so for the $360. But we also had the note in January and February, right? So we're going to have to pay interest for those 2 months that we had it for this year. So we're going to have to take $12,000 times 9% and times it by 2/12 to get our current year interest. So we're going to get interest, and that's our interest expense for the current year. And we're going to pay all of that when we make this payment. All right, so the note and all the outstanding interest. All right. So if you guys have any questions on this, let me know, or post your questions in the discussion board. Okay. Let me know if you have any questions while you're doing all of your assignments.